Todd, I want to talk to you about dividends briefly. And guys, feel free, Simeon and Ed, feel free to weigh in here. We have all been worried that dividends would be cut down dramatically this year. And it seems like the worst case scenario hasn't happened. Todd, I'm wondering if you could comment on that. And this is good news for Simeon. He has the Dividend Aristocrats ETF, NOBL. We'll talk about that in a moment. But Todd, what's the status of dividends? And are we out of the woods on worries that we might see a lot more significant dividend cuts later in the year? Is that off the table?
The second quarter of 2020 was the worst. We actually saw twice as many companies either cut their dividend or suspend their dividend than a more positive impact of either initiating or raising the dividend. In the third quarter of 2020, and this is using data from S&P Dow Jones Indices, we saw 3 times as many companies raise or initiate the dividend and took that negative action. We've seen specifically actually some more technology and growth-oriented companies like Accenture, Microsoft, Texas Instruments. These are all companies that raised their dividend in September. We're seeing a number of technology companies raise the dividend. You mentioned Simeon's Dividend Aristocrats. That actually has a low weighting within technology, but they have a ProShares S&P Technology Dividend Aristocrats, TDV, which focuses on companies that have raised dividends for the last 7 years in the technology space. And there's a lot of great companies there. We also see hefty weightings within Vanguard Dividend Appreciation, VIG, and WisdomTree's U.S. Quality Dividend Growth Fund, that's DGRW. These are more forward-looking or shorter time period of a look back, and technology companies as of late has really been driving the dividend growth story, and I think that's something we're going to see more of heading into the fourth quarter.
Well, the important thing, and that I'm hearing from you, is second quarter was the worst. And I saw this from the S&P. It doesn't seem like we're seeing any increase. Indeed, some people have reinstated the dividend. That's kind of what I'm trying to get at here. There was a real scare 5 or 6 months ago. Yeah. That seems to have passed now.
You know, Bob, you have to dig into it, though. I think it's true at the broad market level that dividends have always been more resilient than price, and that's one of the key advantages of being a dividend-oriented investor. If you look year to date, to Todd's point, we calculated about 15% of dividend payers have cut this year, so it's not trivial, but it's not an unmitigated disaster. But if you split it up, the vast preponderance of those cuts are from low-quality companies, whether they're levered companies, whether they're companies with high dividend payout ratios, high dividend yields, low credit quality. Right. But if you look at the good quality stuff, you mentioned the S&P 500 Aristocrats, the index that our ticker NOBL follows. Yeah. One company is cut year to date. So there are definitely haves and have-nots in the dividend resiliency equation.
Right. And Ed, one of the lessons we constantly point out about the dividend business is that in general, not all the time, but in general, you want to buy into companies that are consistently raising their dividends over many years, which was the Aristocrats' ideology or methodology, rather than buying companies that simply pay a high dividend where you could have a risk that the dividend could be cut. Would you agree with that? That generally, if you're into dividends, that's probably the way to go?
So I would agree with that, with one quick exception. The only exception is you also want to look at the other side of the ledger, the debt. Are companies using debt to continue to raise that dividend so they can stay within, whether it's indexes like Noble or just be quality overall, in the eyes of the investor? So you have to look at the company as well and how much is their debt increasing just to sustain that dividend. But overall, companies that are good quality companies, as Simeon said, that continue to raise their dividend without taking on debt, without cutting in environments like we just went through, generally they can be good companies to go for. But you really do want to look in what's happening with those companies just to make sure that they're not increasing any of their risk, just to make sure that dividend continues to pay.